For 7 years, Dr. Peng has taught financial management and international finance courses at both undergraduate and MBA levels at multiple AACSB accredited institutions. She received recognition for excellence in teaching from the Office of Provost and Outstanding Teaching Award at UConn. And she's going to present on ethics in your money.
Well, thank you, Melissa, for the introduction. Hi, everyone. I am Peng. I am currently an assistant professor of finance at UCS. I've enjoyed here very much, as well as the events held by the Daniels Ethics Fund so far. So today I'm going to discuss how the Daniels principles could be applied in the finance industry. Actually, these principles are consistent with a lot of finance codes, ethics codes, or standards in the industry. So I do want to mention this to all of you here today. And these are the contents I'm going to mention to my students in my finance classes as well. So let me get started. So the title of the discussion today is Care and Feeding of Your Own Money, an ethics case study for financial advisors. So actually a lot of the students I teach here at UCS, they're planning on being a financial advisor in the future. So in my finance classes, actually I'm gonna bring them some of the ethics cases where they could face in their real professional life in the future, where they could face ethical dilemmas of what they should be as a what they should be doing as a financial professional. I'm gonna teach 31 students in my fixed income class and about only 3 students in my international finance class this semester. For my case study, we're gonna be focused around the CFA Institute Code of Ethics and Standards. And the CFA Institute is called Chartered Financial Analyst Institute. This is one of the most influential and largest institutes in the finance professional industry. And all of their members and candidates must abide by these ethical standards and codes. Violations may result in disciplinary sanctions. So again, students will review the case, some of the key cases with me and discuss how they can serve the clients fairly and ethically when they face similar situations in their finance professions. So I feel like basically all of the Daniels Fund ethics principles apply to or are constant with these codes and standards. And we're, of course, here I'm listing all the principles of our Daniels Funds: integrity, trust, accountability, transparency, fairness, respect, rule of law, liability. So it was actually surprising to me to find that indeed all of these principles are very core and essential in the finance professional industry as well. For example, transparency. We all know that there were a lot of financial scandals, right? Where CEOs or managers, they have agency issues, they act on their own benefit instead of represent the shareholders' values. So transparency, disclosing financial information of the company is very crucial in the finance industry. And from a financial advisor's perspective, they have to be transparent with clients as well. Integrity, accountability, fairness, treating all the clients fairly, and respect all the clients fairly. These are very, very important in the finance industry. These are some of the guidelines or basic things for the ethics and standards in finance industry. Professionals, they have to act with transparency, integrity, candor, and trust. Again, these are consistent with the principles. And nowadays we have the main ethics for the investment management professionals, which we will address later as our focus today. But also the CFA Institute has investment industry standards, which is more detailed compared to the basic ethics codes. And then they also have a professional conduct program where people can learn these things more in detail. For the basic code of ethics and standards, they're very important and fundamental to the values of CFA institutes, and they're essential to achieving its mission to lead the investment profession globally. And they're critical to maintaining the public's trust in financial markets and in the investment profession. To begin with, according to the Code of Ethics, the financial advisors, they should act with integrity, competence, diligence, respect, and in an ethical manner with the public, clients, prospective clients, employers, employees, colleagues in the investment profession, and other participants in the global capital markets. They should also place integrity of the investment profession and the interests of clients above their own personal interests. They should also use reasonable care and exercise independent professional judgment. So a lot of the keywords highlighted here are seen in our Daniels Fund principle too. They should also practice and encourage others to practice in a professional and ethical manner that will reflect credit on themselves and the profession. And they should promote the integrity and viability of the global capital markets for the ultimate benefit of society. They should maintain and improve their professional competence and strive to maintain and improve the competence of other investment professionals. Those are the general guidelines, and for the detailed standards of professional conduct, they should have professionalism. They should have the knowledge of the law, which is consistent with the rule of law principle here. They should also have independence and objectivity, and they shouldn't do any mispresentations or engage in any professional misconduct. So basically, they have to abide by accountability and integrity here. Integrity of capital markets. Members and candidates who possess material non-public information that could affect the value of an investment must not act or cause others to act on the information. They also must not engage in practices that distort prices or artificially inflate trading volume. So no market manipulation here. Duties to clients. When they serve clients, they should put clients' interests before their employers or their own interests. They should do fair dealing, suitability, performance presentation. They should be fair, accurate, and complete. And they should preserve confidentiality. And duties to employers include loyalty, additional compensation arrangements, responsibility of supervisors. They must act for the benefit of their employer. They must not accept gifts, benefits, compensation, or consideration that competes with their employer's trust. As for the investment analysis, recommendations, and actions, they should abide by the diligence and reasonable basis. They should have good communication with clients and prospective clients and report retention. Conflicts of interest is always a big thing. They should disclose any conflicts of interests, and they should have priority of transactions. Basically, they put clients' transaction before their own transaction, and they must disclose any compensation if they have referral fees. And responsibilities as a CFA member, they should conduct as participants in CFA Institute programs, and they should reference to CFA Institute, the CFA designation and program. And besides those codes and standards we mentioned, there's also additional investment industry standards here, including the Global Investment Performance Standards, GIPS standard, and as well as ESG disclosure standards for investment products. So ESG investing is a very trendy thing now in the financial industry. A lot of big funds, they're creating ESG investors, and we see that for the millionaire investors, they do have a strong preference for ESG firms or funds, even though some of the firms may bring them less monetary payoff when they purchase such company stocks or invest in such funds, but people do have a preference on the ESG products. Asset manager code. As the asset managers, they should also have high standards of professional conduct. The integrity of the investment industry should be built. Diversity, Equity, and Inclusion Code, DEI. A diversity of perspectives will lead to better investor outcomes, and inclusive investment industry will better serve our diverse society. Pension Trustee Code. The adoption of the code is voluntary and promotes professional excellence among a pension plan's trustees, trust among the plan stakeholders. Endowment codes. This outlines ethical responsibilities for the sound management of long-term financial assets. Okay, so let's look at some of the cases. And here are just a few examples I'm going to discuss with the students. But the case one here, which is related to client advice, I think it's very consistent with our transparency principle here. For example, we have CEO here. He's a founding partner of the Lexer Asset Management firm. And Reeves, the CEO, provides asset management and allocation services for high net worth individuals and a number of small institutional clients. His services include investing client funds with third parties advisors who have a specialty in a particular asset class. His clients are aware of and approve Lexer's allocation of their assets to sub-advisors. The third-party sub-advisors make payments to Lexer based on the total amount of the client's assets placed or invested in certain sub-advisor funds. He initially sought to negotiate a direct economic benefit for clients, but sub-advisors would not agree, and payments were made directly to Lexer. So here are options for all of you here to choose from. Reeves' actions are option A, appropriate, because Reeves has disclosed the use of sub-advisors. B, inappropriate, unless Reeves discloses the financial arrangement with the sub-advisors to his clients. C, appropriate, if the clients receive the ultimate benefit of the sub-advisor payments in the form of discounted Lexer fees. D, inappropriate, because the payments are an improper referral fee. E, not the above.
I was thinking B, appropriate unless we disclose the financial arrangement with the sub-advisors to his clients.
It's a good guess.
Oh, I think it's A, because the sub-advisors were specialists in this field. And he said he disclosed it to them.
Actually, B is the right answer.
B,
Because he has to disclose to his client as well. So his clients should have full, he should disclose to the clients. Transparency here, he should be totally transparent to the clients. Here is the analysis for this case. So again, this is related to the conflicts of interest between advisor and clients. The CFO has a disclosure of conflict standard. The members should make full and fair disclosure of all matters that could reasonably be expected to impair their independence and objectivity or interfere with their duties to their clients. So in this special case, the payments by sub-advisors to Lexer based on the account of client assets that Lexer places with the sub-advisors create a potential conflict of interest because it incentivizes Reeves to hire those sub-advisors that pay the fee to Lexer, but who may not necessarily be the best sub-advisors for his clients. So even though he personally doesn't receive the money, but the company does receive some money. Reeves could mitigate the conflict by passing on any economic benefit received from the sub-advisors to his clients. He initially attempted to negotiate a direct benefit for his clients, but his proposal was rejected by the sub-advisors, and it's not clear from the facts that Reeves is ultimately passing the benefit on to his clients. Even if that were the case, Reeves should disclose the source and nature of the discount clients. He has disclosed Lexer's use of sub-advisors, but it seems the financial incentive has not been disclosed. Although referral arrangements may be acceptable with full disclosure to clients, he's not referring clients to the sub-advisors by hiring them directly on this client's behalf. So here, B is the best answer. And this case is actually based on the real US SEC enforcement action from June 2018. Okay, let's look at another case here, which is about client relations and is more related to the fairness principle in our Daniel's Fund's principle. We have this time another money manager called Korloff, and he's serving several clients. One of the clients, the pension fund, accounts for 35% of the assets under management at Korloff's firm. The fund pays more management fees to the firm than any other client. The executive director of the pension fund has made it clear that because of this dominant position, she expects Korloff to give the pension fund enhanced service in the form of advanced information on investment recommendations, priority position for initial public offerings, supplemental research reports on potential investments, and daily personal contact. Korloff should A, refuse to comply with the request, B, comply with the request only if his preferential treatment does not disadvantage other clients, C, complying with the request because the fund is such a large and important client, D, complying with the request because the fund is paying for the preferential treatment with the higher fees.
As to comply with B, like there's no way you can't come in a disadvantage if you give them information before everybody else gets to.
Actually, for this question, B is also best response. Let's look at the analysis here. So here we're talking about the standard fair dealing, which again is consistent with the fairness principle in Daniel's Fund. It states that all the members and candidates must deal fairly and objectively with all clients when providing investment analysis, making investment recommendations, and taking investment action. Treating clients fairly means not favoring one client over another or discriminating against clients when disseminating investment recommendations or actions. Differentiated service to clients in the form of personal, specialized, or in-depth service to clients who are willing to pay for premium service is acceptable under the standard as long as you don't affect other people's interests.
But are they paying for premium services if it just so happens that they have a larger amount?
Right.
Oh, you mean they're paying, so the, one of the clients is paying the extra premium service in order to get the extra service.
Okay,
So
because
that-
I thought it was under the condition because they were 35%, that they were generating more money, and that's why they were asking, right, so I wouldn't consider that paying, it just so happens that your pension fund accounts for 35% of the assets, and so that's not necessarily paying them, is it?
Oh, but it also says the fund pays more management fees to the firm than any other client. All right, so here fair dealing also indicates that recommendations be distributed in a way that all clients for whom the investment is appropriate for have a fair opportunity to act on the recommendation. Korloff may provide preferential treatment reflecting the amount and level of fees paid by the pension fund in the form of supplemental research and daily contact to the pension fund without disadvantaging other clients. By different levels, but different levels of service cannot disadvantage or negatively affect other clients and should be disclosed and made available to all clients and potential clients. So in this case, providing enhanced service to the pension fund is acceptable as long as the preferential treatment does not disadvantage other clients and has been disclosed to them that they can also receive an enhanced service along with the pension fund. So there are two aspects of the request: providing advanced recommendations to the fund and giving the fund priority position for initial public offerings IPO would disadvantage other clients by systematically benefiting the pension fund at the expense of other clients. So here B is the best option. Okay, our last case today, case 3 example, is about financial disclosures, and this is consistent with our transparency principle here in Daniel's Fund. So now we have a third investment advisor here called Raffle for Enright Financial Solutions. He enters into an understanding with a friend who's a lawyer regarding the referral of clients. He will refer EFS, the clients from his investment advisor who need legal services to the lawyer in return for the lawyer recommending clients needing financial advisor services to Raffle and EFS. This arrangement is A, acceptable because there are no payments involved, B, acceptable as long as the lawyer discloses the arrangement to the clients he refers to. Raffle. C, acceptable as long as EFS is aware of Raffle's agreement with the lawyer. D, unacceptable.
B plus. Since I go ahead, they would also have to disclose the other direction.
I was thinking A, because there's no payment involved, and that they're only recommending.
It's actually D here, unacceptable. Right, so this case deals with a mutually beneficial referral arrangement whereby service professionals refer clients to one another. Although such an agreement is not necessarily unethical and may ultimately be beneficial for the clients, there is the potential for a conflict of interest that must be disclosed. So the CFA requires members, especially the referral fee standard, to disclose to their employer, clients, and prospective clients any compensation, consideration, or benefit received from or paid to others for the recommendation for products of services. So this disclosure allows both clients and the employer to evaluate any partially showing the recommendations of services and the full cost of those services. Although there is no money changing hands between Raffle and his friend, there is mutual consideration and benefit. The fact that no money is exchanged would not preclude disclosure. Choice A here. Choice B addresses the disclosure issue, but places onus of disclosure on the lawyer and not on Raffle. So the standard requires Raffle to disclose the referral management to any clients he refers to the lawyer and any potential clients referred to him by his friend. But B only says the lawyer discloses to the clients. So it doesn't mention whether Raffle discloses or not. And then for the first one, again, even though there's no payments, but there is like mutual recommendations here, which actually influences clients' thinking and decision making. And then choice C also addresses the disclosure issue by correctly stating that Raffle must disclose the arrangement to his employer, but this does not go far enough because standard VIC requires disclosure to be made to clients, prospective clients, and the employer. Does Raffle disclose any information about the arrangement to his clients or EFS? The facts of the case do not mention that he made the appropriate disclosure. So, yeah, for C, it only says that Raffle discloses to the employer, so it doesn't mention about his disclosure to clients. The CFA Institute Ethical Decision-Making Framework calls for you to identify all relevant facts before making a decision. Assuming Raffle made no disclosure to his clients or employer, this arrangement would be unacceptable. Okay, so that's all of our discussions today.